Hi, folks. This is Sean Hyman from The Logical Investor, and I want to talk to you about how not to be emotionally motivated, how not to be news oriented, and how to be fundamentally and technically oriented, which are measurable metrics. They're really sane metrics. They're how you keep on the straight and narrow mentally, psychologically, and not get sidetracked, because the job of the investor is to stay rational and logical and to stay in the middle of the road, so to speak, and not get off in the ditches. And uh, your tendency, because it's every investor's tendency, is going to be to get on the emotional side of investing, to get on the news driven side of investing. Because as much as I've taught even former subscribers to not listen to the news, what's the first thing they're going to do as a natural habit of their daily life? Lots of times they're going to turn on the nightly news, they're going to turn on CNBC, Bloomberg, etc. They're going to hear the news of something, and they're going to make a decision based on that news. And that's not a wise decision. News is fickle. News tells you what is presently happening, and what has happened has nothing to do with what the stock will do. And a lot of times, by the time that the news happens, the stock corrects and adjusts so fast that the impact of the news is already, for the most part, usually priced in the stock. So there's all kinds of reasons why you don't listen to the news. Well, another reason is they're reporters. They're not making a living by investing. They are, again, reporting what is happening or has happened, but they have no idea what will happen. And it's the job of the investor to look to what will happen and to stay fact-based. And that's how you stay logical. And that's why I named this newsletter that's coming up, The Logical Investor. So I want to talk to you about one stock that's been in the news lately, because I had a former subscriber say, I'm thinking about selling my Qualcomm stock. And I said, why? You must be, watching the news too much, because I've taught against that all through the years in that former newsletter. And because they hear, oh, Apple is on Qualcomm, and they don't want to, pay for this and that, and there's a legal battle and blah blah blah. Well, one, you don't know the outcome, and just because Apple's in it doesn't mean Apple wins it. If Apple wins it, you don't know how much is won, how little or how much. All kinds of variables in there. And two, does it change the fundamental picture of Qualcomm? So a lot of people will first look at too short of a time frame. They'll look only at the daily 1-year chart. And again, I look at the daily 1-year chart, but it's not the only one that I look at, because it's like if you put your nose to a big screen TV, you're not going to see the entire picture, but you're going to see part of the picture, and you're going to see part of that picture probably in kind of a blurry fashion. But if you take a step back so many feet, your peripheral will be able to kick in, and you'll be able to encompass and take in the entire picture. And so only looking strictly at a daily 1-year chart is like having your nose pushed to the middle of your TV, and you're not seeing the full picture. So, for instance, if you just look at Qualcomm here, it's hard to tell the trend of the chart, and it's kind of up and downsy, and doesn't look so hot, even though you'll still pick up that this 50-day moving average is still trending higher, that the peak of selling volume was back here, and even the most recent selling volume on the Apple news paled in comparison to what it was back here. So those are all bullish. So there are things you can pick up. The RSI is not near as deep as what it was here, so it's still heading higher, all sorts of things like that. But when you look to the weekly, one, you can still tell that the long-term trend is up. Look at this 200-week moving average, and you'll see that it's still trending higher. You'll see that it had a huge run from 23 to 74, and over the past, and this is a weekly 10-year chart. So from 23 to 74 with very little pullback, that's a big time overreaction to the upside to a stock. So it needed a major pullback. So those of you who have followed me for a long time know that I'm a proponent of Elliott waves when looking at charting. and that helps you denote uptrends and the phase of the uptrend that you're in, and also downtrends and what phase of that downtrend that you're in. So you know that once these huge moves happen, there tends to be three-wave massive corrections. So massive moves up tend to have massive corrections. And so would you agree that from 23 to 74 is a massive move? Yeah, it's over a few years, but still it's like a tripling in price. So here's your A, B, C, or your three-wave correction lower. So this is probably the next bottom in Qualcomm, next long-term bottom, because remember we're on long-term charts here. So Qualcomm is not really likely to fall below this 40, and then it ran from 40 to 69.72, so almost 70. So from 40 to almost 70 again. Once again, it needed some pullback anyway, and it it got it, and it had huge sell-off here. I mean, probably 230 or so million shares net sold in a week here. So notice the selling is dying off, and it's a lot more muted than what it was here. So when that starts happening, when you have a massive reaction and it starts dying off, usually people were selling at the wrong time. If you look at most big companies and you look at when most people are selling them, they're selling them at the wrong time. So look at this massive weekly selling spike here, which was over 350 million shares net sold in a week. So they're selling this stock right here in the 29s to 26s for the most part. And so what is this? Maybe call it a year or less after, it's in the 51s. So, how would you like to sell it in the 29s or 26s and then it practically double off that low to 51s? You'd be kicking yourself. Yet this is what the masses routinely do. So when you see unusual spikes, I'm not just talking about any selling spike, but selling spikes that are basically 2 to 3 times normal volume. And how do you know what average volume is? Look at the volume over a good 10 years and see where most weeks hit. It's where most of the activity is. So Qualcomm in more recent years, 80 million, maybe 100 million shares traded in a week would be pretty typical. 50, 60, 80, 100, anything like that would be typical. So when you're looking at something that's like 150, 200, 250, etc., that would be unusual selling activity, which is 2 to 3 times average selling volume or average volume period. So knowing that means that when they came down here and were they were selling it in the, call it 50, 52-ish range or whatever, it's probably an ultimate overreaction. And it doesn't mean that it can't go lower in the near term, but it means that probably a year or so from now, that stock will likely be significantly higher. So let's go back and rewind to this point in history here. So there was this huge sell-off. It bounced up, and then it did ultimately go just a little bit lower. It went a few bucks lower, no doubt. And then it just started bolting towards new highs. And by the way, if somebody had held it another year, it'd have gone from 26 to 59.99, so basically 60. So, and then had they held it, a couple more years, 74. So, they're selling here, and just a few years later, it's tripled up off of its lows here. So people are usually selling at the wrong time. So, and by the way, what's the news media going to be like in these times? In a week like this, and even a week like this, weeks like this, when you flip on the news, what's going to be on CNBC, Bloomberg, Fox Business, etc.? Is it going to be positive Qualcomm news, or is it going to be brutally negative Qualcomm news? It's going to be the latter. It's going to be. So they're watching TV, they're watching headlines on the internet, and they're making investment choices and decisions based off of that. And it's one of the dumbest things that they can do. So here was a big spike up where they're selling at 23s and 24s, and months later it's back at 40, and months after that it goes to almost 42. So you can just go through a lot of big stocks and find that. So one, you need to be looking at bigger picture. Um, Two, you need to even most importantly check out the fundamental situation. So let's go look at Qualcomm's fundamentals. So, and by the way, this is not for those of you who are new to my videos and stuff like that. This is a recommendation that former subscribers are in, and so I'm just highlighting it. But this is not necessarily saying for you to go and buy it up, even though it is very fundamentally strong, which we're going to find out. But when I start the new portfolio here, there's not going to be any questions about whether I'm recommending buying something, etc. So there will be official recommendations that you'll see come out. So Qualcomm one has a dividend yield of 4.23%. So the person was going to sell a very high yielding stock in a very low yielding world. So that's one thing that stands out to me. It's got a market cap of $78.63 billion, even after it's taken the recent hit to its stock price. It's still a 78, almost $79 billion company today. How likely is that company to go under? Not very. Okay, let's go to statistics, and this is the thing I look at the most on Yahoo Finance, which is at finance.yahoo.com. I still think they have one of the simplest, easy to read sites out there. Finance.yahoo.com. You put in the symbol. You'll start off on the summary page, which was the one that we were just on, and then you can go to the statistics page, which will give you a bigger breakdown. So there's our 78 billion market cap. Price to earnings ratio 17.73, which the market right now overall with the S&P 500 is like 24 to 26. So it's still its trailing PE is much cheaper than that of the overall market, and its forward PE on expected earnings is 15.79. So that's far cheaper than the market on average. So that means that the stock price is cheaper relative to its earnings than the market overall. So that's a good sign. It's got good profit margin, 17.26%, operating margin 25.46%. It's got earnings. This is just a fancy way of saying earnings before it's messed with. Earnings before, I think it's interest, taxes, depreciation, and amortization. I believe I've got that right. Anyway, it's before all the fundamental, before all the accounting gymnastics have been done to it, and all the jostling of numbers to make something read like somebody wants it to read, all the weird magical accounting that can be done. This is strips all that out. It's just raw earnings, in other words. $7.15 billion. Yep, that's right. That's with a B, billion. So they're making $7.15 billion last year. How likely are they to go under? Not likely. Total cash on the books, $20.86 billion. There's only so many companies out there that have 10 or 20 or more billion dollars of cash sitting on their books. That's a pretty stinking big deal. How likely are they to go under? Not very. Yet there's some people that just because they hear a hot stock on CNBC or Bloomberg, etc., mentioned, they'll go out and buy it, and it may have a handful of $1 million of cash on its books, and they'll be totally fine with that. But yet sometimes they'll want to sell one emotionally that could even have 20 billion, almost 21 billion dollars of cash on their books. And again, I'm not bashing this individual at all, because it's a common mistake. They've been a faithful subscriber of mine. I can't say a bad word about them. I appreciate them. But I'm just using it as an example to give you, to kind of teach a lesson on it. So total debt, $21.9 billion, which may initially sound like a lot of money to an individual, right? But it's in light of its size of $78.63 billion. So they've only got less than a third of their market caps, in other words, of their size, in debt. So that's actually very healthy. If you have a third or less in debt compared to your market cap, you're a very healthy company. And if you have 50% or less, you're still considered healthy, just not extremely healthy, but definitely still on the healthy side. And anything above 50% is not so healthy. So, of course, and you may be thinking, hey, any debt is bad, and that's really a misnomer. You've been taught it from the mindset of consumer debt. So having consumer debt, putting on credit card, clothes that are going to depreciate in value, food, gas, all kinds of stuff like that that's going to depreciate, be consumed, used up, go down in value, and yet you're still stuck with the debt. Yeah, it's stupid every day of the week. But so why do companies carry some debt? Because they're able to leverage what they do. So if a company, let's say, can make 30% on their money by producing a product or delivering a service and turning that around to either a business or the consumer, and if they could borrow, for 6% or 8% to make more product or deliver more services, then it's worth doing that. See, the average individual is going to be, paying, 10 to 20, sometimes 30% interest, and they're not making anything on their money. And if they are, they're not making the type of returns that a business could make. So if I could borrow at 6 or 8% and turn around and make 20 or 30% with it, that's called successful leveraging of OPM, other people's money, to increase your earnings, to widen your profit margins, to take market share, to expand your business, to merge or acquire with a company to get a leg up, all kinds of stuff to widen your profitability and your earnings. So there is a time and place for that, and so don't confuse business debt, if done right, what it can reap for somebody, with consumer debt, which 9 times out of 10 is always bad. I mean, there's used to people would say, financial guys would say, home debt is okay and college debt is okay, and they'll say home debt because it's a house appreciates in value over time, and college debt because you can leverage what you would have made prior to the college degree. You'd make so much more over the course of your lifetime with the college degree, so therefore that's worth it. And I would say some of that info is starting to get to be not all that legitimate, because there's a lot of people who go to college these days and they can't even guarantee that they will have a job, much less a high-paying job. And the college costs versus the increase in income is not near the advantage that it once was. So the risk to reward is not near as advantageous as what it once was. So I'm more of an advocate of getting scholarships or paying it cash as you go, or go serve your country and let the military pay for it, or something of that sort, to where somebody doesn't come out with a load of debt. On a house, I would say there's a right time and a wrong time to buy every asset. I don't care what it is. So stocks in general go up throughout time, but every day is not the time to own every single stock. Real estate over time does go up, but if you bought in 2000, late 2007, early 2008, it was a horrible time to be buying real estate. But yet real estate is a valid asset class that a lot of wealth is created over time. So there's times to buy every asset under the sun that can appreciate, but just because you have an appreciable asset in general doesn't mean that it's always the best time to buy something. Also, concerning real estate, there's a lot of people that will be over-levered in their own personal finances, meaning they bought too much house, they've got too big of a mortgage note relative to their pay, and that asset can become a liability because they haven't set aside enough money in cash to where if there were gaps in employment that they could still pay that house note, etc. So there are some caveats to some of that information, but there's a right time and place to own everything or to not own it. And going back to what I was talking about before, following the news as your source or your stimulus of should I buy or should I sell That's one of the worst um, pieces of investing advice you're ever going to get is by following the news. Um, I had some friends that, again, they're not stock market people, but they're great people, good friends, and they said, "Oh my gosh, Amazon! I hear it almost daily on the news. Maybe I should pick up some Amazon stock because they're doing so much and doing so good." And those of you who've been following me for any length of time, you know that when a stock gets way away from its 200-week moving average, it has a tendency to come back down to towards that average over time. And when it gets massively away from it, the correction that comes can even far overshoot that moving average. And this is the furthest in the last decade and probably in its history that it's ever been away from its 200-week moving average. So in other words, it's one of the highest risk times to own Amazon stock in its trading history, and probably you would probably have to go back to the dot-com bubble to find something that was the equivalent. Matter of fact, let's just go back and look real quick and see if that was the case. So no, it wasn't even the case then, because the 200-week moving average would have come back right in here, which is where the average would have been. So it would have been extended in 98, 99, and 2000 some, but nothing remotely like what it is right now. So that parabolic move is going to come to an end. And but again, see, if people are using the news, they're thinking, "Oh, Sean, you're the one that's on another planet, because don't you turn on the news? Haven't you heard what all Amazon is doing?" And they can't fathom a day where Amazon would go from 1,000 to 555, much less, because it's almost guaranteed to overshoot and go down into the 400 or so over time. Again, this will take time, but the down cycle could start any day now. I'm not saying it's going to, but it could. So the risks are super high whether it does or does not. See, the risks are there whether you feel them or not. The risks were there in housing in 2006 and in early 2007, yet nobody felt them. But the risk was still there. The risk was just felt later on. Well, if you wait until you feel the risk, you are in hot water big time and in a mess. So let me tell you another one. So Apple, great company, solid company, has more cash on its books than any company in the entire world, has more cash on its books than some countries have in cash reserve. So it's a great company overall, but it's a horrible time to own it. So we have bought it when it was out of favor, and we've taken advantage of run-ups that were here, and even part of this one. And people are come back and say, Sean missed it on this one because he got out a little too early. And no, Sean got out when it became high risk, and it could have just as easily gone back here or here, just all the same. But it got there was more hype in the news media and different things like that, so it went up a little further, a little longer, and but it's still super high risk. So back here, Apple was high risk in the 120s to almost 130, and it came back to 88, 89 area. That's a big, serious pullback, and especially percentage-wise. Back here, Apple was king, could do no wrong in the news, and it was everything at 90, 91. And then it fell back to 51. So again, massive risk, massive pullback. Was Apple still the same company here as it was here? Absolutely. But this was a better time to buy it, and this was the super high risk time to buy it. So just on the technicals alone, you can tell a lot of things about measuring risk. So I hope this helps you to quantify. Should I be in a company or should I not? The first and foremost thing you should do is look at the fundamentals, because no matter what the chart looks like, if the fundamentals are crap, you shouldn't buy it. So if they don't make any money or not much of it, if they don't have much cash on their books, if they have super high debt relative to their market cap, if they're super small market cap to begin with, all these are signs that you shouldn't own it. If they're billions of dollars in market cap, billions of dollars in cash on their books, billions of dollars in earnings, low debt compared to their size, low PE, etc., it might be a consideration for buying. On the technical charts, if the price is very far away from the 200-week moving average, it's a horrible time and a high risk time to be buying that stock. If it is in an uptrend, which is denoted by the 200-week moving average, and the price is pulled back towards that rising 200-week moving average, it becomes a lower risk time to buy that stock. So even if you don't know fundamentals, just that one trick alone can help you at least avoid a ton of the downside in a stock and to assess high risk versus low risks. So, the price gets far away here, it goes down. It gets far away here from the 200-week moving average, goes down. And again, these don't look like big, but they're big when they were back here because this is 23 and this is 10. So more than cutting in half. This is 24, this is 14s. So, and again, when it gets away from it, it doesn't mean that it has to go immediately down. So it will be high risk, but it doesn't mean certainly to short it. That's why I'm not for advocating shorting a stock because it starts going up and getting crazy here, and you might be trying to short it at 70 and it goes down 91 on you before it finally turns. So I'm not for shorting. But when you're seeing if you're in the stock and the stock's getting crazy far away from the 200-week moving average, might be time to consider selling and waiting for it to come back down out of the clouds and come back to more sanity. Let the positive news headlines die down and maybe even turn negative for the stock, and the price plummet towards the 200-week moving average, which is rising, and then buy again. So this is not short-term trading in and out, by the way, either, because like this would be selling out in early 2012 and not really getting back in it until latter first quarter of 2013. So we're not talking about day trading or short-term trading. This is not Jim Cramer Mad Money or any of that craziness. This is stewarding your assets well and wise investing. So here it goes up to 128, comes back to the 88, 89 area. Here we went up to 156, and again, there's a massive chance that this comes back to 105, 110 or less. And nothing says that it couldn't go much lower, because again, when they go far away from the moving average, the percentage pullback can be huge. And so just food for thought. So this is one there, Apple and Amazon are examples of two that they're super bullish on in the news. It can do no wrong. And the dumb money, which are the ill-informed retail investors, they can't gobble up and get enough of it. And they're buying at the very worst of times. They don't feel it just yet, but they will feel it in the months and year or two ahead. And unfortunately, they will lose a lot of money. Qualcomm, they are either selling out at a bad time or they wouldn't touch it with a 10-foot pole, and yet it's got great fundamentals. And so when they're looking to the news and they're saying, oh, it's bad news, so I should be selling or not owning the stock, they actually, when the news gets really bad for a solid, huge company, is the time you should be looking into buying something in general. So again, just a general counsel on some of these stocks that are stocks that are widely talked about out there right now, that are stocks that we have either held or had in previous portfolios, or that are just in the news a ton. So I hope this helps you. I hope it kind of helps realign your thinking, recalibrates it, and brings it back into balance, because your tendency as an investor is going to be, even though you've got this news today, even though you've got this revelation today, and you're realigning your expectations, guess what's going to happen so many months down the road, probably not even a year or two down the road, and sometimes even weeks down the road? Your tendency is going to be going to go back to listening to the news, back to watching the headlines, back to being emotional and not logical, back to irrational, back to not looking at the facts, which are the fundamentals, back to looking at things that are measurable, which are technicals and fundamentals, versus things that are not measurable, which is just like some analyst's opinion of a stock on TV, or a reporter reporting something about a lawsuit or missed earnings this quarter, or yada yada, and those are horrible guides So anyway, just wanted to set the record straight on that, and to hopefully what my point is, you're going to need to rehearse this type thing over and over and over again until you're sick of it, to really get entrenched in there. I've been doing this for over 25 years now, and the first so many years, I've ingrained this stuff in my head. I repeated this stuff in my head. Um, I read the Warren Buffett quotes, the Sir John Templeton uh, quotes in books, and listened to people who have been doing this 20 and 30 years, and when I'd only been doing it a handful of years, and listening to how they thought, and they thought this way that I'm teaching you. And I had to ingrain myself, entrench myself in it, because my tendency was going to be to go back to novice investor thinking. And the reason why people think, oh, the stock market's rigged, is because they use the news and emotions as their guideline of when to buy and when to sell. And it has nothing to do with the market, but it has everything to do with them using unreliable, unpredictable things for their buy and sell triggers. Because remember, the average person doesn't know how to value a company. They, excuse me, they can't tell you whether it's undervalued, fairly valued, or overvalued. But by simply looking at the fundamentals, you can see that alone. And at this point in the newsletter and then follow me, you don't have to know any of that. Well, you never actually have to know any of that. You can just follow and listen to me, and I'll teach you about all that. But there is an exact way to know if something is undervalued, fairly valued, or overvalued. And now, just because it's overvalued, does it mean that it's got to start going down tomorrow? No, it just means it's high risk. And you have to be willing to leave some money on the table to avoid all of that downside risk. And when it goes low and it's a fundamental value, doesn't mean it's got to stop and halt its decline and turn around and start immediately heading back up. No. Matter of fact, most of the time it's not going to do that. And that's why I'm a proponent of averaging down. So when there's big percentage drops from the first or last times when you bought into a solid, huge, fundamentally strong company, you can average down and bring that percentage break-even price, much, much lower. Because a fundamental value that is a value tends to get more of a value before it turns around and heads higher. Why is that? Because markets are sentiment driven. When investors are negative, they're extremely negative. When they're positive, they get to a point where they're extremely positive. And when they're doing that, they're misvaluing the asset in both times. And the news media and the headlines help them do it. So that's why I'm saying you got to have a consistent gauge that is timeless, that has worked over time. And believe me, in investing, it's not immediate gratification game. Look at Warren Buffett and how he talks, and he thinks in, years and decades and 5-year increments and all this kind of stuff. He doesn't think in, well, it's been 2 months now, my stock's not positive, so I'm selling this, I must be wrong on it, or something like that. I mean, that's just dumb. And if you think that way, you've got to shake that way of thinking, because investing, if investing were easy, everybody would do it. But everybody can do it, but it requires it requires two things. It's just like what the Bible says. The Bible says through faith and patience they inherited the land. Well, that's what you're going to need in investing to inherit the successful, the land of success in investing. You're going to need faith in a company. And how are you going to get faith in a company? You're going to look and see, I have a lot of faith in the company when I know they're a 70-something billion-dollar company, and they let's go back to that, and they have in earnings $7 billion, and they've got cash of almost $21 billion, and their debt is small relative to their size, and hey, that tells me a ton. And when I go to the profile area, I can usually see on most of these stocks how long they've been around. Let me see if it tells on this one. They got 30,000 employees and so forth. May not have it on this, but oh yes, it does in the description. Here it is. Usually towards the end of the description. So this company's been around since 1985. Been around a long time. This is not some new startup or something like that. They've been through a lot of technological changes and cycles, and yet they still stood the test of time, and they're still making billions of dollars. Again, that's in the profile section, and you scroll down to the description towards the end of the description. So I'll tell you another one right now. IBM is another one that that is getting bashed in the news. So let's look at IBM real quick before I close out this video. Okay, let's go to the profile. 380,000 employees. This one has been around since 1910. I mean, how many technological changes you think have happened since between 1910 and today? And yet they've made those changes, the needed changes, rolled with the times, grew with the times, and changed. So since 1910, a technology company that's been around that long. It's a $137 billion company, and it's PE of 12 on the trailing 12 months, dividend yield of 4.08%. You go to statistics, it's got a forward PE in the tens. They made $18 billion last year, $12 billion in cash, $45 billion in debt. But remember, they're a $137 billion company. So again, that's healthy too. So how likely is IBM to fail? Is it probably going to fail in the next month, week, year, 2 years, 3 years, whatever? Not very likely at all. And its price to earnings. By the way, price to earnings ratios don't get cheap typically when the news is good. And the price to earnings ratios are typically expensive when the news is just hopping, when it's just awesome. So just know that if you want to buy stuff at a value, if you want to buy low and sell high rather than try to buy high and hope to God that it goes higher, that's a dangerous game on the ladder. But if you want to buy low and sell high, then you got to be willing to step in there and buy when everybody thinks that it's has-been company, when it's junk, when they think it's crap. But when you look at the fundamentals, and you see differently. This is how an investor creates an edge. This is how they can outpace the markets over time. This is how they can have faith in a company because of its size, fundamental soundness. And then the next ingredient is totally up to you, which is patience. Faith and patience. Patience is something that you have to develop, cultivate, and exercise. It's not a gift. Nobody naturally has a ton of it. If you do a word search on it in the Bible, you'll find that through a lot of trials and tribulations that people have developed has developed patience. And so it's something that you have resistance and pressure and tension, and yet you have learned patience through that, in other words. So investing teaches you to be patient, even-keeled emotionally, mentally tough, etc. And it teaches you to not listen to what's going on out there, what people are yan about, whether it's headlines and blogs online or whether it's traditional news media and the financial TV. Go back to the numbers, go back to the data. That's what really the company is. And go back to the charts and take a look and view it, particularly on the weekly 10-year charts. But the daily 1-year charts are good for looking at what's happening, more near term, medium term. But if you want to see like the long term, go look at a chart on the weekly chart and see what it's doing. And if it's way away from its 200-week moving average, you need to sit on your hands and you need to wait for a better day to buy that asset. And if it's come way back towards its 200-week moving average that's rising, then it's a better time to be buying that asset. And keep in mind, the news is going to be horrible here. It's going to be hopping and great here. It's going to be horrible here. It's going to be great here. When we were sellers of Apple, it was Steve Jobs was everything, and then when he passed away, Apple was a has-been company. It's never going to be anything. Tim Cook's never going to be able to do anything with it. Blah blah blah. It goes down because it's looked at the time as a has-been company. we pick up a lot of shares of it, and the thing goes and soars. And so we've been through I think 3 waves of it now, and it was some of the biggest returns that we had. By the way, what is an expensive price stock? So don't look at the per share basis and say, oh, I shouldn't buy that stock because it's $100 a share, and so therefore it can't go up much percentage wise. That would be ill-informed. And don't load up on a stock just because it's cheap. Oh, it's $5 a share, I should buy. You can buy a stock at $5 a share and it be expensive because it may have a high PE. And you could buy a stock at $100 a share and it might be a low PE and a value. So the price per share has pretty much zero to do with it. So price per share is what a novice looks at. PE ratios, how solid a company is fundamentally, where it is in relation to its major moving average, which is the 200-week moving average, things like that. That's something that a pro would look at. So learn to think like a pro. Yes, you're not going to be a hedge fund manager, a mutual fund manager, a pension fund manager. I know that you're going to go on to be electricians and plumbers and whatever you are as your day job, and I would expect that. But you can be those things and still learn to think like a pro and not have to do that as your day job. But it is required that we develop pro-like thinking in order to be successful in investing. So anyway, went a little long, but I wanted to make sure that this got ingrained in you. So thanks so much for watching, and God bless. Bye-bye.